listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. Thank you so much for tuning in today. And with me again, I believe we had him on last time, is Vince Lanci from Echo Bay Partners. Vince has been a former market maker. He's a trader. He's managed a very significant amount of risk. So if you really want to know what's going on with respect to the gold market, micro happenings as well as macro, you have to find guys like this. So Vince, I wanted to have you on today because my main question is, we obviously saw this big move in gold today, and as you pointed out before we started recording, it's really a much bigger move than people think given how the stock market sold off, and obviously bonds were sold off as well. The 2-year yield has jumped above 3%. But up until today, this action typically has been negative for gold in the sense that it would imply that there's going to be more Fed tightening. So you'd see gold and precious metals suffer, but and maybe we had that was a reaction initially, but then gold reversed course pretty strongly. And I'm just wondering, maybe a two-part question. At first, what caused that reversal to the upside for gold? And then secondly, could this be some kind of inflection point or some kind of leading indicator for the next couple months that maybe gold is starting to decouple from that a little bit? I know there's, it might take a while to answer those two questions, but that's those are my questions for you today.
Okay, I think that's a lot, but let's try and break it down a little. First of all, thanks for having me on again. I had a lot of fun last time, and I appreciate getting the call on this because I love stuff like this. The first part of I'm going to try and address your two questions, but I see like really three different things that I can talk about that are on point. The first is, yeah, you're right. Your comment about gold not being strong relative because of QT and Fed interest rate tightening fears. Number one, that's true on a absolute basis, right? So gold has been weaker since the Fed hikes have come in and since the QT has been talked about. However, when you look at gold, and this is not like a sales pitch, you have to look at things at an absolute as well as relative. But on a relative value basis, gold has held increasingly better over the last 2 months relative to stocks. So what I mean by that is if you view the stock market as inflated and you view the gold market as undervalued, let's call it fairly valued, you never really know, then the Fed's behavior, sure, in the past has been something that decimated gold along with stocks. Stocks will be down 2%, gold will be down 2%, stocks will be down 1%, gold will be down 1.5%. We're so used to seeing that when stocks come off that you wonder if gold is a hedge for the equity markets at all. And this is important to dovetail to what happened today. Over the last couple months, I've been watching the behavior, and yes, gold has been selling off along with stocks. But it used to be, as I said, 2% down in gold, 1% down in stocks. Now you're seeing 2% down in stocks, 1% down in gold. Now, that's like, being the one-eyed blind man. It may not be that exciting. But the reality is there's a trend there, and in fits and starts, I'm seeing gold perform, hold its own, let's just say, better than stocks do in the face of Fed frugality. And that's turning a corner. There had been some other market moments where stocks would drop and gold would rally. And, I checked around, and the reality is the first thing is, and the first reason that we're getting this is there is a secular U.S. investment trend. And that trend is, if you're a retiree or someone who's close to retiring, you have a lot of money, forget the fact that stocks are going down, but the volatility alone can give you a heart attack. And so people are saying, I want out. Well, bonds stink too. What am I going to do? Well, most of their money is going into cash. But, 5% is going into gold, let's say. And that is starting to grow during U.S. hours. I'm seeing a lot more flows into gold, manifesting into GLD. Now, that's the thing that's going on. That's a trend that will continue as long as the Fed, even if they raise rates, that is a trend that will continue to exert itself as long as stocks go down and as long as real rates lag inflation. Right now, inflation is 8.6%, we'll just say, and rates are 3%. So just picking a number out of my hat. So that puts real rates at minus 5.5%. So anyone who says bonds generally attract gold because the yields are high, that's only true when the real yields aren't so negative as they are now. But that's the first part. Does that help a little bit?
Yes.
Okay. So your comment about stocks, I think, is really important, because how many times have we, not been very happy about that? Now, the second thing is, and I've seen this sporadically, it's not something you look at as a long-term investor, but back in the 80s and even the 90s, when bonds were the bond trading market, they called them the bond vigilantes. You remember those?
Right.
The bond market was the policeman for the stock market. And I do know that over the last 6 months, a lot of the bond funds are speculating on gold now. What does that mean? Well, during QE, gold only went up when stocks and bonds went up. During QT, the bond guys are buying gold when bonds go down. And they're so big when they put money into such a small market like gold that they push the market in an exacerbated way. And today was, and to your point about what a big range it was, today was the biggest effect that I've seen them have on it. It's happened in the past. You've seen big moves in gold over the last 6 months where it'll happen when bonds go down. If you look back and you have some correlation model, you'll find that. But usually the day after, gold just gives it all back. And that's because the bond guys, they love to punt with their extra money, but they also trade hot money. Today is, number one, the biggest move I've seen from their effect. Number two, it came on the back of people putting their money into gold equities. As you pointed out, what did you say the GDX was up today?
About 4.8%.
Yeah. So you now have these two massive forces pushing on gold, and gold was up almost $50 from the low. So I would say that do not be surprised, and I'm not trying to throw water on it, do not be surprised if gold gives it all back on Monday, along with bonds rallying. But the trend is you're going to see more and more V-shaped bottoms in gold and more, I'm using a technical term wrong here, rangy or distributing tops in gold. So I think it really is a good sign that no matter what happens, there's no one left to sell gold. That's, there's a lot of other things I can get into, but the U.S. domestic investment is definitely looking at gold a lot more now. That's the first thing. And the second thing is bond players are allocating money into gold. And if you had an intraday chart, you would see that the gold reversal happened when the 30-year bond, a 10-year bond as well, started dropping. So CPI came out today, right? And the number came in high and hot. And the initial reaction for the 30-year bond, forget the 2-year bond, because that's the Fed funds, that's governed by the Fed funds. The 30-year bond rallied strong, and 30-year yields came off, as stocks, kind of dumped. And that's the flight to safety concept. You know what I mean? But a half hour later, bonds just started dropping, even at the 30-year. And as they dropped, gold upticked with them. So I'm saying that the really, really deep-pocketed, really smart people are saying you don't want to be short gold now. That's it. I hope that helps.
Yeah, so it sounds like today is not necessarily an inflection point, but the larger point is that there's a lot of support for the gold market, even in the face of rising bond yields. And it sounds like this support from behind the scenes is something that, if you're correct, then it's been building over the last 3 or 6 months.
Right. The inflection point, I think people who aren't as close to the markets as we are might call it an inflection point, but you just described, I think, what it is. It's a tipping point. I think we're close to a tipping point where bad news is bullish and good news is bullish for gold. Now, it's been going on for some time, but it's real. Today was just a massive move off the lows, and I think you're right. It's like I think the bond guys are catalysts for the bigger next leg of gold to take off, and I think it's an inflection point if you're looking at it once in a while. But if your head's in the market like we are all the time, then it's just more momentum building. That's what I think.
Right. And so, gold, it looks like it closed at 1875. 1880 to 1900 is really stiff resistance. I know we could go anywhere with this question, but I'm just thinking, what is it going to take for that to break? Could that break to the upside before it becomes obvious? In other words, if we don't see the rate of inflation come down materially in the next, let's just say this summer, and
right.
The Fed gets these 250-point hikes off, maybe one of them is 75, but the economy this summer continues to weaken, the odds of recession increase materially. Is that can gold really move ahead of that just because, hey, excuse my language, but the market will see that they've been raising rates, inflation's not coming down, now the economy's going into recession. Wow, we're really fucked. What are they going to do? Can gold continue to move up in that environment before the Fed just has to cry uncle and say, oh, okay, we got to stop hiking, the economy's too weak?
That's a really good question because it involves the whole when will the Fed stop hiking, and after that, how soon will they start easing? And that is the gist, sadly, of American economic monetary policy right now. And to your point, the Fed is, although they're not going to say it out loud, I'm telling you it's true. The Fed is hell-bent on risking inflation risking recession to get inflation in check. That's number one. Number two, they're not going to say it. Number three, as soon as inflation gets to their target, which I don't really know what it is, you're going to see them reverse. And the question that brings up is, how does that play out in gold? Well, I'm not sure how it plays out in gold, but I am pretty sure, I am pretty confident, sure is not the right word, I'm pretty confident of the behavior of the Fed going forward. Like, to your point, at what price does the Fed stop? At what price in stocks does the Fed stop raising rates? I don't know, but I do know that they want to get housing values lower and stock values lower. So there's a number they have in their head that if it gets below that number, they will take their foot off the gas. I agree with you. The second part of that is considering that it's become even more apparent as of today, for example, that we're behind the curve in raising rates, will they get more aggressive? And I think the answer to that is yes. And I think you brought up 75 basis points. You're only the second person who said that, but you're in good company. The other banks came out with their reports today after the CPI number, and they said they think another 250 basis point hikes. Who was it? I think it was Barclays, and they're pretty good on this stuff. Barclays said, we're going against the consensus, and we think the Fed's going to go 75 basis points. And now you're getting to the politics of it. If I were running the Fed, and I'm not for good reason, and I had no political risk, I would be raising rates more aggressively now because, as you and I both know, they're going to have to raise rates on the back end. I mean, lower rates on the back end to stabilize stocks. The problem is the Fed is, unfortunately, in a political situation. I mean, we can't deny it. Midterms are coming up. And, you know, some people smarter than me said the Fed will continue to raise rates until September. And then after that, they might lower rates. Or put it this way, after that, they'll pause. And the rationale for it has to do with the politics aspect of it. So my answer is the faster and more harshly they raise rates, the faster and more harshly they will rescue the stock market. How does that affect gold? Well, and that's just domestically. We're not even talking about, you know, Russia and the ruble and China accumulating gold, and we're not even talking about that. But I think that net has until we start lowering rates again, that net has a neutral effect on gold. So if they raise rates, let's exaggerate, right? Let's say if they raise rates 200 basis points tomorrow, what's gold going to do? It's going to go down. It's got to go down, right?
Of course, yeah.
Yeah. But stocks will go down more. And then what does the Fed do if stocks go down more from a 200 basis point rate hike? They rescue stocks, but not gold. Like that's the type of stuff we're going to start seeing, I think. I mean, we won't see it, but we'll experience it.
But gold is sorry to cut you off, but gold is outperforming stocks. I mean, we talked about that. I mean, you've mentioned that. I mean, the ratio, that's looking really solid, gold to the S&P 500, that ratio. So gold is outperforming stocks. So it's hard for me to see an environment where stocks are going to outperform gold. I mean, maybe on a day-by-day basis, but I mean, but aside from that, I also think, I mean, talk to me about this. Everyone is, you know, the whole country, the politics, inflation's the number one issue. That's why the Fed is hell-bent on getting it down. But, I mean, I think at some point it's going to become growth and recession. Like, that's going to mirror the Fed flipping, because if you get in a full-blown recession, everyone's going to think that inflation is probably going to come down at some point. You know, the psychology will have a role in that. I mean, I don't know. Maybe I could be wrong. I just want your thoughts on it, since you follow these things on a day-to-day basis and much closer than I do. I mean, just look at another thing, not to put us down another rabbit hole, but another thing I was looking at, and I did a video on this yesterday, the Fed, they shifted their policy really fast during inflationary eras.
Yes.
Like, and they cut rates. I mean, if you look at the late 60s and 70s and once in the 80s, I mean, they were cutting rates with the CPI really high. So I definitely don't buy. And in addition, I mean, how much can the Fed do? They can't print oil. They can't speed up the supply chain situation. I mean, yes, they can, you know, they could really crash the economy if they want to get positive real interest rates. But it's like, and I think you tweeted this, and also Larry McDonald, you know, you and him, two amazingly sharp people. You basically said something about, you know, if we really want to get inflation down, the Fed's going to have to put us in a depression, basically.
Yeah, he's, first of all, thank you for including me with him. He's a really smart guy. Yeah, he's going to an extreme, but he might not be that far out an extreme. There's a lot of moving parts to what you just said. Let me just start with the first part.
I know. I'm sorry. There's too many.
No. But you got the guy here to talk about all that stuff. I just don't want to. I don't want to go off on a tangent. But I'll try and keep myself organized. First of all, with regards to gold outperforming stocks, right? I think that's a trend that will continue and probably exaggerate over the next 5 years. So I'm zooming out to how you're looking at it. Full disclosure, I don't own gold stocks. And that's not because I don't like them. It's because I believe that gold companies are very dependent on management. And I think it's really hard to find good management. I've had personal experiences with management of gold companies. And so, full disclosure, I don't have gold stocks in my portfolio. I might change that, but that's because it is not in my expertise. It's just, I'm a commodity guy. I'm a geopolitical, macroeconomic guy. I am well-read in fundamental analysis. And every time I talk to a gold company management, I just get sick because I can't find the good ones. So maybe I have to talk to you offline about that. So what I'm getting at is gold and gold-related equities should outperform the S&P 500 for over the next 5 years. So, maybe not next year, but over the next 5 years, I think they'll do better. And I think that's just a simple, straight-up combination of demographics. The volatility in the market is making people upset, and the Fed is going to continue to let the volatility in the markets go because they want the market to kind of self-clear a little bit. The second thing, see if I can recall that. What was the second thing?
Good question. Something about I guess here's something. I mean, how much? I guess it would be a two-part question. I mean, how much can the Fed? How much are these hikes really going to bring down inflation and help inflation expectations? Right. Because I think they would have to go to like 4% before there could really be a dent. No. And we know they're not going to get to 4%. Right.
Well, you're totally right. And yes, your next question, the next part of what you asked was about basically how realistic, how reasonable is it, where could they get to, and then the whole recession versus depression concept.
I guess my second thing was about how fast psychology could shift from damn gas prices, damn this inflation, to damn it, we're going to go into recession, I'm going to lose my job. And then that's another thing that aligns with the Fed shifting policy, in addition to all the Wall Street, mainstream financial people who've been living off the Fed's teat,
right? Who
are saying, who are going to be calling the Fed saying you got to cut rates again. We're losing too much money.
Right. Yeah. That's actually it. Okay. How soon will people pivot from fears of inflation to fears of recession? Sooner than in the past, because, as you alluded to, I think there's a generation of people that are spoiled by the Fed, and most of them are Wall Streeters. Some of them are, just regular people that are retiring soon, and because of that, there's what do you got, the 25-year-old hedge fund manager who's never seen his stock go down in his life? I mean, it's an exaggeration, but that's what we're dealing with here. So that force, I think, is going to make the Fed's job of raising rates that much harder than if this happened, say, in 2008, 2009. I really think you have a psychology in the market that is so used to being bailed out that, look at the president. The president is basically putting it all on the Fed's shoulders. And although that's not necessarily all their responsibility, and everybody, look, the Fed is a rock star now, right? Since Bernanke, right? Or since Greenspan. And so now they expect him to do these magical things. And I made an allusion to that today with that old Winter Warlock. We'll talk about it another time. But I think the politics of it, and the politics are driven by the public, right? Because of their opinion, make it very, very hard for the Fed to do their job effectively. Now, to put a number on it, people, I think I looked at a ton of reports on this when it started happening, and interest rates, real interest rates, have to get to positive 3.5% to get us on track to control inflation. To your point,
that's a depression.
Getting
if that happens.
Real interest rates to positive 3.5% is raising rates to 8% right now, which puts us in a depression, right?
Yes.
That's a crash. So Larry McDonald, his point about we could be in a depression to get inflation under control really isn't ridiculous. So why isn't the Fed panicking? I think they are panicking. I think they are hiding it well. And here's my reasons for it. One of them is what was said to me today, and one of them is something that I've observed. One of them was, I said, you know what, maybe the Fed's going to have a 75 basis point surprise hike before the next meeting. And the guy said, he's an old-time bond guy. He goes, no, they'll never do that. I go, why? He goes, they won't do that because that will telegraph to the market even more uncertainty that they don't know what they're doing. They may raise it 75 basis points, even a full percentage point at the next meeting, but they're not going to do in-between meeting hikes to really unsettle the market. I said, okay, that makes sense, right? That's why they're not. So the point he's making was they're panicking, they won't show it. The second one is, and this is my opinion, but I think it's, I know what my opinions are like made up, but this one's not made up. The Fed is banking on this war. The Fed is praying for some relief to come in this European, Ukrainian, Russian war. Because if it does happen, you're going to get some, not a lot, but you'll get some relief on whatever this combination of sanctions and embargoes and boycotts is doing on oil. And that is the case, isn't it? Like you said, they don't print oil. They need to get oil down. I saw a statistic today that really underlines you saying that. Something like, if you factor energy out of CPI, I have the real stats somewhere. It came out today. If you factor energy out of CPI, CPI is at their target. And I'm not proposing we factor energy out. I'm saying if they get the price of oil down, they're going to fix the whole problem. And they're probably really, like Biden is probably right now, hat in hand, flying over to Saudi Arabia saying, please pump oil. We'll give you more jets. We'll let you have nukes, whatever he has to say. I mean, I'm joking, but I'm not, right? Please make peace. Zelensky, please give them a little bit of land and end this. Like, we're crying uncle over here behind a curtain. Until we get oil down, this inflation will not go away, period. That's the key to all of it. And that's why, in my opinion, Larry McDonald said that, because if we don't get oil down, if the Fed is genuinely serious about stopping inflation dead, then they have to put us in possibly a depression. So, yeah, I mean, it's not crazy.
Okay, so here's another. I don't recall if this is one of my questions or if I mentioned this at the beginning, because I know I can talk in circles. So we know the Fed, they're going to hike 1% or maybe 1.25% over the next couple of months. I mean, is it possible gold could, or maybe I just missed your answer. I mean, is it possible that gold could break 1900 like convincingly before the Fed actually shifts policy? I mean, is that possible, even though, if oil is still high and bond yields are at these levels, and there's the implication the Fed is going to hike, 50 or 75 in September? I mean, is it still possible that gold could break that resistance convincingly because the high inflation has I don't know what the right word is, but the higher inflation, it makes the market discount more tightening, but at the same time, it makes the economy weaker and moves us closer to the Fed cutting. I don't know if you.
No.
Did I make that clear enough? I mean, I'm not trying to give you to make you say gold's going to go up in any scenario, but because I don't believe this myself, but I'm just trying to think, could gold actually break that resistance before the Fed actually shifts?
Okay. You pick the numbers. I'll tell you what I think is going to happen, right? I think this is a good way to work on this. I think if you tie a couple things together without being hyperbolic or sensational about it, you're going to come up with the following. I think anybody who's got, money in the market and half a brain is going to say, there's a good chance the Fed will slam on the brakes if stocks go too low. And if that happens, what will gold do? Let's put a pin in that. I don't know is the answer for the moment. But before the Fed slams on the brakes, what will happen? Stocks will crap out. Bonds will get very volatile, like we saw today. One day they may go up as we do a whole flight to safety. Another day they may go down as people worry about inflation. So let's say that the Fed raises. The market is discounting the Fed raising 1.25, which I think is a fair statement, 75 and 50. And stocks, and let's say a GDP number comes out, an economy number, not an inflation number. GDP comes out bad, and it says we're in a recession. We're in one, by the way, but we can talk about this some other time. The data comes out, we're in a recession. Stocks are going to, I'm exaggerating now, go to zero. What will bonds do? Bonds will go up because people will take their money out of stocks and put them into bonds. What will gold do? Gold stocks may go down, but gold will go up. I think if the market is trading here, 1875, and you have a recessionary print, then gold goes up above 1900, no doubt in my mind. And I'll give you the logic behind it without getting too, esoteric. If the Fed raises rates, why are they raising rates? Because they're chasing inflation. They can't get under control. That's bearish for bonds and bullish for gold. If the Fed lowers rates because stocks are dropping, that's bullish for bonds and bullish for gold. Gold, I think, has tailwinds no matter what they do. And everybody who's into gold who listens to this is going to get this. Gold doesn't price inflation. Gold doesn't price disaster. Gold is not a safe haven per se. Gold is ultimately the perfect barometer of confidence in leadership. So if we have strong inflation and the Fed has it under control and we think they have it under control, gold won't do anything. Of course, it's probably got some little manipulation going on there too, but we're not doing that. What will happen? If we think stocks will drop and the Fed's got inflation under control, stocks drop, bonds rally, and then the next day it kind of stabilizes. If we don't think the Fed has inflation under control, which is exactly what happened in 75, 76, 80, 81, what happens is at some point people say, mom and pop investors say, as well as the big bond boys say, man, the Fed just does not have a serious compulsion to get inflation under control. They're just going to chase it. And people just throw in the towel and say, just put it in gold. I don't have time for this bullshit anymore. So if you look at gold the way I do, I look at gold as a proxy on confidence of the people in power. And that's how the Fed looks at it. So as the market gets more and more skeptical of the Fed's confidence, which means if they don't raise rates right away, gold will go up. If they raise rates too much, gold will go down and then up. Everything points to gold going up. And it sounds very facile to say it that way, but I kind of think the next economic number that comes out, if you're looking for a behavioral thing, the next economic number that comes out, if it's a GDP number and it shows we're in a recession, what will gold do? I don't know. Stocks will go down, bonds will go up, and gold might be unchanged. If the next economic data comes out is inflationary, and that inflation is another new high, gold will go up. Gold will go up, and stocks. And here's to your point about stocks in recession. Stocks will go down, testing the Fed to see if it has the nerve to do its job, and gold will go up, testing the Fed, see if it has the nerve to do its job and stop inflation. That's my answer. Hope that helps.
Yeah, that helps a lot. So let's just wrap things up if we can quickly. I mean, maybe this isn't really a question, it's more a statement. It seems that we're potentially moving into a point in time where gold, there's whatever happens with regard to, Fed policy and government policy, gold is probably going to go up, or we can say it's not going to go down. I mean, it doesn't.
Yeah, that's a good way to say it. The Fed as a cap on gold is going to be less of a factor going forward. I agree.
Because even if the Fed wants to be really tight, the smart money knows that, or let's just say, bond traders.
Yeah.
If the Fed wants to be really tight, bonds will get hit. So some of those bond guys will support gold, like you're saying they've started to do. But also, smart money knows if the Fed wants to get really tight, that's just going to accelerate how fast they're going to have to shift on the back end.
Right.
So that's why in any scenario, gold is really well positioned over the next 3 to 9 or 3 to 12 months or 3 to 2 years, whatever.
I agree. So let's go through the scenarios, right? If they get aggressive and raise rates harshly now, then gold probably goes down, right? Bonds probably go down but stabilize. Curve probably flattens or inverts, and stocks get crushed. And as soon as they do that, and the whole, oh my goodness, what did we just do, thing sets in, then they're going to be quickly reversing. And that'll make stocks go up, but not as much. That'll make bonds go up, but not as much. And that'll just make more people say, I don't really think the Fed knows what they're doing, and put money in gold. That's my opinion. On the other scenario, which is they get to do it slow and long and drawn out, which is what they're hoping for, that's where they keep gold. That's where they keep a little gold. If the next inflationary print is lower than this one, then the Fed's going to be comfortable, because then something is going to happen. Oil is going to get slammed, and they're going to feel, and I'm setting us up for like 5 years from now, 2 years from now, the Fed's success now will breed even more arrogance, and the next problem we have will be way bigger than this one. And if you look back at history, we got inflation, quote, under control in 76 because inflation went up, and then the economy did poorly, unemployment went up, and somehow the Fed magically got inflation under control for 76 during the whole bicentennial celebration. And then they let it happen all over again. We got new highs in inflation, new highs in unemployment, and I think the Fed's either going to fail now and gold will go up, or the Fed's going to succeed now and gold will go up more in the next 2 years. That's where I come down on this, and my position reflects it.
Okay, fantastic. Vince, I thought this was really great. Would love to have you back again in the next month or so we can do this again. Before I let you go, can you give out your Twitter handle if people want to follow you there? You're an active tweeter, but also you write the Gold Fix. Can you tell our listeners where they can follow that and subscribe?
Sure. The Gold Fix is a free newsletter dealing with economics, geopolitics, with a heavy focus on gold. It's vblgoldfix.substack.com. So just do VBL Goldfix. Now there's a paid version of it as well, but there's a free one there, and there's some content that you'll be able to access. It won't be like clickbait stuff. So yeah, I appreciate that. If some of you want to sign up, I'll do something to make it worth your while because of your relationship with the Daily Gold. With regards to my Twitter, it's Lanci, VLANCI Pictures. It started out as a pictures account for my kids at twitter.com. I will warn you that the writing that I do and the way I present on the newsletter is not how I present on Twitter. So it can get a little bit, on a good day, my humor is obscure. On a bad day, it's obtuse. So I'm just going to forewarn you guys about that. Okay?
Okay, so Twitter for entertainment purposes, the Gold Fix for informational and educational purposes.
That's exactly right. In fact, some of the Gold Fix material will be used in I'll be teaching a university class this fall at UConn, and I'll be using Gold Fix material to teach that class. It's on futures and options. So whatever you get on that on the newsletter will be hopefully quality stuff. That's what I'll say with that. But yeah. So thank you for that. Yeah, I'd love to come back soon. We can come back when gold's down $100, and you say, "But Vince, you said." I don't have a problem with that.
Right. Vince, thanks so much, and we'll talk again soon.
Thanks, Jordan. Thanks for having me on. Great being here.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.